There was a budget on the 6th of April 2024 announced by our Chancellor Jeremy Hunt. Follow my video and I'll explain everything that's relevant to you and your business. Our mission is to help small business owners exactly like you. So please click the bell and subscribe to be notified every time we produce our best pieces of content, but more so we can get our message out to others. Taxation for a small business owner like you can be really daunting and it can be quite nerve-wracking. We have this conversation a lot with our clients. But what I'm going to do is condense the key bits that are relevant to you. But please do not constitute this as advice. This is March 2024, and as time goes on, this is going to go out of date. Now make sure when you take that advice that's relevant to you, make sure they align with your personal business goals, because every decision should. Your personal allowance. This is the amount that you're allowed to earn completely tax-free. Now this has been frozen at £12,570. Technically, this is a tax increase, because we've gone through the most mad times with inflation that has been in double digit. So there should have been a good argument that personal allowance should have gone up by 10% or more, but it hasn't. It's remained the same. So while you are not having anything taken away from you, it's not rising with the current times that we're living in. So 12,570 is your personal allowance, and this slice of income is what you're allowed to earn tax-free. Income tax rates and allowances are frozen too. Again, this is an indirect tax rise because we've been in double-digit inflation. So all of the tax rates are remaining the same. So the personal allowance is the same, middle rate's the same, higher rate's the same, and the additional higher rate tax as well are the same. So what you tend to find with a lot of small business owners is they'll get themselves in a category, I tend to find. So there are some small business owners that would like to get as close to 50,000 as possible, which will be the middle rate band, and some will like to sit at 100, and some will make sure that they go way over 150. All these tax rates are exactly the same. And we've seen in recent years as well, dividend tax has been hiked up quite a bit. So make sure when you're looking in your business, you're looking at the optimal ways to take money out of your business. Because it's not just salary and dividends anymore, you've got opportunities with charging interest on your director's loan account. But I know you knew that already. Tax savings on income. These have remained the same. So if you're a middle rate taxpayer, you can earn £1,000 in interest completely tax-free. Now this is quite interesting at the minute because we've lived in 10, 15 years with interest rates have been uber low. But it's possible if you get the right account that you can get 4.5%, 5% in interest on that. That was never heard of over the last decade. We will start to see individuals that may start paying tax on their interest. Now, that's a good move because you don't want your money to stand still, you want it to get bigger. So make sure that you don't get caught out by ignoring interest on your self-assessment. Because if you're a higher rate taxpayer, you're only allowed to earn £500 tax-free, but if you're a middle rate taxpayer, you can earn £1,000. Now, if you do the math, it's not going to take a lot to get there. But if you're a small business owner yourself and you've got a nice director's loan account that's in credit and not overdrawn, you can charge interest on that loan account too. I love this because you're basically saying goodbye to dividend tax, and you'll be taxed at normally 20 or 40% depending on when you're middle or high rate taxpayer, but the company gets the corporation tax benefit as well. And I'll talk about corporation tax later on in this video, but it's going up. So if there's a way of reducing your corporation tax and move it into your personal life, you should be all over this because it's a massive opportunity. Taxation on dividend income. Again, this is where the rug has been pulled away again. You were allowed to earn £1,000 a year tax-free through dividends. This is reduced to £500. So there is a chance that if you're employed, you've got a share portfolio that's not held within a pension or an ISA, you could end up having to pay dividend tax on your self-assessment. If a small business owner, largely you're going to be taking dividends out your company, your allowance is going down, so you're getting another little price hike again. So make sure when you're doing your remuneration planning from your small business, you are looking at all of these areas to make sure that what you thought you had last year is actually the same this year because the dividend rates are going down. Individual savings accounts, ISAs, they are fixed at 20,000 that you can invest in one each year. Be mindful of this, you can only invest in one provider. So you can't do 5 grand here, 5 grand here, 5 grand here, 5 grand here. It's 20 grand with one provider. Now, not many people are going to be in a position where they've got £20,000 to invest. That's a considerable amount of money if you're looking to do it every year. Now, what is beautiful about ISAs is there's no income, there's no CGT, and it's easy to get your money out. If you've got already taxed income that's in your personal name, I think ISAs are beautiful, because if you can then adopt a short-term strategy, i.e. with a cash ISA where none of that's going to be taxed, or you can then start investing in the markets for your long-term growth with your financial advisor. And if you could do this every single year, 20,000, and the benefits of compound interest if you get it, these are a beautiful tool. No income tax or CGT, and it's easy to get your money. These are beautiful. Child benefit. The rate of where you have to start paying it back has increased. Way. It used to be if one of you earned more than 50,000, you'd have to pay back your child benefit charge. It's now going to 60. Now, but there's also a gap on where it tapers down, because a lot of clients that we found that were getting child benefit will have to pay it back through their self-assessment. Now, once you've had that money and paying it back, although it's what you needed to do, no one likes to pay back money that they thought that was theirs. But it's going to be clawed back in a marginal rate, where by the time that if one of you hits 80,000, you'll have to pay back all of your child benefit. So I think, again, make sure that you are claiming child benefit if you're entitled to it. If you're consistently a 90, 100 grand or more earner, just don't bother applying it at all, because what comes in one hand, you have to pay back on your self-assessment. It's really annoying, plus the money you wasn't entitled to that money in the first place, so just don't get it. If you're employed, the tax saving that people are the most excited about is on national insurance. So in January 2024, the national insurance rate that you pay if you're an employee went down by 2%, winning. So anyone that's employed has had a result through this current government. For anyone that's employed has had a massive win. In January 2024, you saw your employees' national insurance go down by 2%, winning. Now, on this budget from the 6th of April 2024, they've basically announced that they're going to do an additional discount. They're going to reduce it by another 2%. So that's a 4% saving if you're employed, which you're going to get more money that comes into your account. This is a big move. This will then help people get through the cost of living and the mad inflation times that we live through, and it will help put more money into the economy, which should get more of it going. So I think this is a really bold move where they put employees' national insurance down by 4%. But unfortunately for small business owners, employers' national insurance has not changed. So I can fully understand why a lot of small business owners are a bit peeved with the way that the tax rates are going for small businesses within the UK. Benefits in kind. Employees are required to pay income tax on certain non-cash benefits. This means that they've had value passed to them without money physically changing hands. For example, a provision of a company car constitutes a taxable benefit in kind. And the reason for that is the employer's not had to go out and buy that car themselves, but they've had full benefit of the use. Now, there are set percentages used to calculate company car benefits that are fixed until the 5th of April 2026, before slight increases apply to most car types, including electronic and ultra-low emissions from 6th of April 2026. The figures used to calculate the benefits in kind on employer-provided vans, van fuel for private journeys in company vans, and car fuel for private journeys in company cars remain fixed at their 2023-2024 levels. In 2025, these are national minimum wage. These have been some pretty big rises, especially in my working career, where we've seen these go up quite substantially. And I'm not for it, I'm not against it. I think ultimately everyone should be paid a fair rate for a fair job for what they do. But for a lot of small businesses, margins can be quite tight. Profits can be quite tight, and there may not be massive flexibility for these national minimum wage rises, because some of these business owners are not earning massive profits either. So you got a bit of a catch-22. But the national minimum wage is going up again. Now, what I'm going to do is I'm just going to put it on screen in a few moments to show you all the bandings, because it changes a lot depending on how old your employees are. So have a look at the current rates on screen now. Self-employed people pay two types of national insurance. They pay Class 2 national insurance and they pay Class 4. Class 2 was fixed and in the old days was known as your regular stamp. That's being abolished from the 6th of April 2024. Self-employed people also pay Class 4 national insurance, and that's based on a certain profit level above your personal allowance. But that currently is at 9% and it's going down to 6%. So this is a humongous opportunity to actually get more money in your hands if you're self-employed or a limited liability partnership. And it's also closing the gap in some ways between having a limited company or maybe a limited liability partnership. We could see it change. Now, I'm not going to speculate about the next election because who is already bored to death with that anyway? Plus, we don't know the outcome. So I think later on this year with an election, it will be interesting to see whether this flavour continues in the same direction or we have a complete U-turn where new ideas and new policies are put in. But again, all you can ever do is keep up to date with the news and make sure that you're tax planning with current data. I cannot stress that more. VAT. If your business currently turns over 85,000, you have to compulsory register for VAT and charge VAT on your income. The exclusion to this is if your business is an exempt supplier. An example for this could be like a financial advisor. With the new rate of 90,000 that's kicking in, it's not every just your financial year. You need to keep a rolling 12-month total to see if you go up and down on that VAT limit. And if you exceed it, you've got to register. Now, I thought the government could actually lower the VAT limit significantly. They've been talking about getting a lot of sole traders doing quarterly tax returns, which they promised and it hasn't quite worked out. But what better answer could you get for giving HMRC the data that they're after than making almost VAT compulsory for all businesses? You would get everyone filing their information on a quarterly basis by default. Now, in the past, the VAT rates have gone up by inflation, and again, they haven't. So I find this quite interesting where they're obviously needing to claw back a lot more money through COVID and all the loans and all the money that they sent out the door for that period that we had. So again, this is another sort of tax burden on small businesses because it hasn't gone up in line with inflation. Annual tax on envelope dwellings is if you own a property within a limited company. There are lots of exclusions that get you out of this, so buy-to-lets are a classic in this. But if you're holding a property and it falls under the annual tax on envelope dwellings, beware that from April 2024, the rates are increasing. Tax relief on expenditure and plant and machinery. This is still, you can get 100% tax relief in year one up to a spend of £1 million. Now, most small businesses that we work with are not going to spend £1 million on equipment in a year ever. So the rates that we're currently receiving for getting all the tax relief upfront on assets are amazing. There are talks that this may change at the minute, but it's in place. So a classic, if you're just getting before your year end, which could be 2 or 3 months before your year end, this is the time where you look at, right, what assets are we going to invest in our business to make it better, because you can then take that tax relief straight away off your corporation tax, or if you're a sole trader, off your income tax too. Motor vehicles, they are taxed as a benefit in kind through your company because you're receiving the value of a car without having to go and pay for it out of your own pocket. It's quite straightforward why you get taxed as a benefit in kind. Now, as a rule of thumb, if you had a petrol car, you would normally keep these outside of your company because you'd end up paying more tax overall rather than taking it out via a salary or dividend. What we've been through in the last few years is electric cars have been amazing for tax. So as I said earlier on in the video, beware that these rates are going up as electric cars become more and more common. There was also a bit, I think it was a bit of a fiasco. This was a complete joke. The double cabs were then taken off and going to be reclassified as a car. And then a few weeks later, then they're reclassified as a van. Come on, guys, make your mind up. But what you need to make sure is that you've got a handle on this information. So if you bought a double cab pickup because you're looking to get the really sweet tax relief on it, make sure that this legislation is still going to be current because they pulled it and then they put it back again. It's a bit of a pantomime. Corporation tax rate. This has been a massive change for the rates that small companies are being taxed. Now, back a long time ago, you used to have a large company rate and a small company rate. And I thought that was quite fair because it was, I think back then it was profits of over 300,000 and then you'd be taxed an additional rate. Now, it's profits of over 50,000, which isn't a lot. This is going to capture a lot of small businesses. So if your profits for a limited company are under 50,000, you're paying 19% on that. If they're above 50,000, which is another 200 on top, up to 250, you're taxed at 26.5%. That is an absolute savage rise. That's a big percentage increase for your small business profits. Now, when you get to 250,000 profits, that additional effective rate will make it that you're paying 25% overall, but that's still 6%. This is big bucks. So when you're looking at planning for your business and you've got enough working capital in there, you're hitting your targets, you've got enough runway in there, but you've got excess money, there's things like pensions which have never ever looked more attractive. Because if you're getting 25% tax going in from the company, that's a big saving. And if you think you're not actually paying the dividend tax on there on entry, I understand that you pay tax on a pension taking it out, but when you're actually going in, this is a big return without having to invest it. So if you've got profits in that range and you can invest them where it's not going to cripple, damage or put the business at risk, this is the time potentially to then double down on growth. Because if not, you are going to have an additional rate of tax taken off your company profits. And if you do the 26.5% differential from 19 and you divide it by 19, that's a massive percentage. So small business owners, yes, I get it. You feel like you've had a punch in the mouth at the minute. Whether these rates change or not, who knows? Whether the election changes it and there's a new party, who knows? But at the minute, I think the opportunity is how do you then reinvest that money? And that could be how do you build your personal wealth, and also what can you invest in your business where you can crack on and go through other levels. Big opportunity, because if you just sit there whinging and crying about it, nothing's going to happen. It's how do you play this hand to your advantage. Capital gains tax. There used to be a really generous allowance for capital gains tax. At the minute it's 6,000, and for the following tax year it's going down to 3,000. So that means if you've got any gains above that limit, you are going to be paying additional tax on this. Now this is going to catch a lot of people out. So if you've got share portfolios, if you've got crypto, if you're a buy-to-let investor that's still got some of their properties left personally, you are going to get hit for more tax, because there's going to be less of the exemption that you are going to receive. So make sure you are planning stuff really well. And if you've got things like in a stock market portfolio, are you using your £20,000 a year ISA allowance to then move it over? Now you can still self-manage an ISA, or you can get a manager to do it for you. So you've still got, if you like to, if you actually, that's your hobby and you enjoy doing it, then carry on in a self-select ISA. But make sure that you are not paying any tax unnecessarily. And doing an ISA is quite mild. It's not aggressive at all. You're taking the reliefs that you're genuinely entitled to. But if you're having gains that crop up that are more than 3,000 in the following tax year, this is going to catch a lot of people out, which means that more income is going to be recorded on your self-assessment and means that you're going to be paying more tax. If you sell residential property, you had additional tax rate to pay. So if you're a high rate taxpayer and you're selling a property that is not your main residence, you have to pay 28% tax on what's taxable. This is now going down to 24%, which is a little win, but it's also your hand's been pulled back with how you've lost your tax-free exemption at the same time. If you are looking to sell properties, make sure you are doing good planning with your advisor in advance of selling these so you don't get an unexpected tax bill wrapped around you. Furnished holiday lets have become really popular, especially after the COVID region, because people were staying in the UK a lot more. From 2025, these are abolished. So all the additional benefits that you had by having a furnished holiday let are going. The inheritance tax threshold still remains at 325,000. There is also additional relief for your main residence as well at the same time, which can take you to approximately £500,000. So make sure everyone's personal balance sheets I'm seeing are increasing quite radically. So what you're looking to do is not pay 40% of your estate to HMRC if you passed away. What you want to do is appropriate levels of planning where you can mitigate the tax legally, but also where you're not paying 40% unnecessarily, and you're allowing to keep your generational wealth flowing down your generations. Tax law changes all the time. So make sure that you haven't taken this video as advice, take it as inspiration, take it as ideas, take it as motivation to make sure that you are optimizing your tax to as legally possible. But if we can help with any questions, feel free to click on our calendar link below. This will allow a 30-minute call with one of my team. We can take on board any questions that you have, and I promise there'll be no pushy sales pitch. Also, take a look at our book, 74 Ways to Pay Less Tax. This is packed with 74 amazing ways that will help you reduce your tax burden. Download a copy today.